NIO stock is having another difficult session today. Despite opening the morning with a small upward bounce, the stock has reversed sharply and is now trading around $5.50, down about 4% on the day as of 2 p.m. market time. This move continues the broader downward trend that has dominated the past 2 weeks, and once again, it's happening without any single disastrous headline driving the action. Instead, the story of the day is a combination of fear, technical momentum, and the market bracing itself ahead of NIO's major earnings report coming next week on November 25th. So let's break down what's actually happening. When the market opened today, NIO saw a small relief bounce. This is normal after extended selling pressure. Traders step in to test whether the trend can reverse, algorithms react to the overnight oversold conditions, and some dip buyers take small positions hoping for a quick trade. But the moment NIO's early bounce failed, the downward trend took control again. And the reason that failure mattered is that NIO had been hovering right above yesterday's closing levels. Once the stock slipped below yesterday's low near $5.75, it triggered a wave of algorithmic selling. This is a critical point. A lot of today's move is not emotional selling from long-term investors. It's mechanical. It's momentum-based. Once NIO broke below 575, and then 570, and then 565, more and more trading systems automatically push the stock lower. NIO is a favorite target of momentum algos because of its volatility and retail-heavy float. When the trend points down and key levels break, sell orders cascade. So the intraday drop is not really about new information. It's about the stock losing a technical foothold. At the same time, there is another layer to today's decline, rising fear ahead of earnings. NIO reports in just a few days, and this upcoming earnings report is shaping up to be one of the most important ones the company has had all year. Investors are worried about margins. They are worried about the price war in China. They are worried about whether NIO can come anywhere close to its target of approaching break-even on an adjusted basis in the fourth quarter. These concerns aren't new, but they are being magnified as the report approaches. When investors are nervous, they exit high beta names early, and that's exactly what we're seeing in the intraday flow. Another major factor weighing on NIO today is the performance of the entire Chinese ADR sector. This is not a NIO exclusive problem. XPeng is down. Li Auto is down. Alibaba is down. JD.com is down. PDD Holdings is down. When Chinese stocks move down together like this, it usually means one thing: global markets are shifting into risk-off mode. And when risk-off sentiment hits, unprofitable companies with uncertain near-term catalysts get hit the hardest. NIO sits right at the intersection of three fragile themes today: electric vehicles, China exposure, and unprofitable growth. That trio is extremely sensitive to macro volatility. Something else happening today that most investors don't see is ongoing selling pressure from EV-themed ETFs. Funds like DRIV, IDRV, KARS, and others are still experiencing outflows. When these ETFs see redemptions, they sell shares of their underlying holdings, and NIO is one of those holdings. This adds a silent but very real layer of selling pressure in the middle of the session. Many investors don't realize that ETF mechanics can move a stock even without news, but on days like today that effect becomes clearer. There's also the broader issue of bond yields rising again. Every time yields tick higher, growth stocks, especially unprofitable ones, feel the pressure. Higher yields mean investors demand more certainty. They move their money into safer assets. They rotate out of names that require years of strong future growth to justify their valuations. So even though NIO itself is not directly tied to bond markets, it suffers from the risk-off shift that higher yields create. And then we need to talk about the psychology behind this sell-off. NIO has now been dropping for nearly 2 weeks straight. It's down around 20% from recent levels. And the longer a stock drops without a positive catalyst, the more investors start to assume that something must be wrong, even when nothing new has happened. This is classic capitulation behavior. People don't wait for clarity. They sell in anticipation of bad news. They sell to avoid what they fear might happen next week. They sell because the pain of watching the stock drop every day becomes too much. This is how downward momentum feeds upon itself. But here's what makes today particularly interesting. There has still not been any new negative development from NIO. No new filings. No production warnings. No recalls. No guidance cuts. No new lawsuit updates. No supply chain disruptions announced. Nothing has materially changed in the past few days. The business looks exactly the same today as it did last week. The only thing that has changed is the market's mood. And moods can shift violently in both directions. This is what makes the period just before an earnings report so volatile. Investors and traders are not reacting to information, they are reacting to the absence of information. They fill in the blanks with fear. They assume the worst-case scenario. And because NIO has been involved in a price war and recently completed a $1 billion share offering, those old headlines get recycled in the emotional narrative. Losses feel larger. Risks feel scarier. And valuations feel heavier. But none of this necessarily reflects what the company will actually report next week. So now the question becomes, what is the right way to frame a mid-session video about today's decline? The strongest angle you can take is the idea that today's drop is a combination of pre-earnings panic, technical breakdowns, and sector-wide pressure, not evidence of something fundamentally worsening at NIO. The market is pricing fear, not news. And that fear grows louder when support levels break intraday. A powerful and balanced angle for your video is something like this: NIO drops to around 550 during Thursday's session. So is this panic selling before earnings, or is something deeper happening? That title and theme let you explore both sides without leaning too bullish or too bearish. You give viewers context, clarity, and calm analysis while acknowledging the real risks. In the video itself, you would highlight the failed morning bounce, the break of yesterday's lows, the algorithms that trigger selling, the weakness across Chinese EV peers, and the absence of new company-specific news. You would explain how pre-earnings nerves magnify small drops into larger ones. And then you would give viewers something to watch for heading into the close. Does NIO stabilize above 550, or does the selling deepen into the final hour of the session? Does volume spike or thin out? These clues often tell us whether fear is peaking or just getting started. You can also explain how earnings next week could become a reset point. If NIO shows margin improvement, even modest improvement, the stock could rebound sharply. If they show progress toward their Q4 profitability goal, even if they don't fully reach it, sentiment could shift faster than people expect. And if deliveries continue strong and operating costs trend downward, analysts will take notice. That's how you balance the narrative: acknowledge the risks, but don't ignore the opportunities. So the takeaway today is simple. NIO is not dropping because something new broke. It's dropping because nothing new has come yet, and the market fears what it can't see. This is classic pre-earnings behavior in a high-volatility stock. And whether today marks a turning point or another step down depends entirely on how the market digests this fear in the final hours of trading. Either way, this moment is a perfect time to analyze the real forces behind the move, not just the red on the screen.